Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
Okay, it is early February 2026, and we are taking a look at the tape for CBAT Energy Technology.
And the numbers are telling a story of extreme compression. As of this morning, CBAT Energy, that's ticker CBAT, is trading in a remarkably tight band between 78 and 82 cents. The last quote I'm seeing is right on the button at 80 cents. Market cap is sitting at about $71.5 million, with volume running pretty thin. Average daily is just over 135,000 shares. But the context is really what matters here. This stock is way off its 52-week high of $1.25, and it's hovering dangerously close to its floor of 57 cents.
Right. It's either a coiled spring or a falling knife. Really depends on your perspective. And that price action, it sets up our central question today. Is CBAT a classic, deep value play that's actually navigated a really brutal manufacturing transition to become profitable? Or is it a value trap that's facing an existential regulatory clock that hits zero in just a few weeks?
I think you have a pretty good idea where I stand on that one.
I do, but my argument is that the market is completely ignoring the fundamental turnaround. I mean, specifically that Q3 2025 earnings surprise and the successful shift to the 4135 cylindrical cells. I really believe the valuation discount here it's extreme. We're talking about a disconnect from operational reality that creates a huge opportunity.
And I'm coming at it from the other side of that trade. I look at the NASDAQ compliance deadline, March 30th, 2026. That is just weeks away. You combine that with really weak liquidity, a current ratio below 1, and some significant insider selling, and, it suggests to me that this is just uninvestable for any prudent capital. That cheapness you see on the surface, it's a siren song. You see value, I see a solvency crisis that's just masking as a stock.
Okay, let's get into the positions then. My stance is that the quote-unquote transition year of 2025 is over. And frankly, it was a success. The market is still pricing this stock based on the capital expenditure cycle of the last 18 months. The cash burn you need to build out factories, rather than the actual results of that cycle. And the proof of concept was the Q3 2025 earnings. We saw an EPS, an earnings per share, of 3 cents against an analyst estimate of -4 cents.
It was a beat, I'll grant you that.
It was a 175% beat. But more importantly, it signaled a real shift in their unit economics. I mean, for a micro-cap industrial company to achieve profitability during a retooling phase is exceptionally rare. Usually you just bleed cash until the new lines are running at full capacity. They didn't. They moved away from legacy products, they successfully launched the Model 4135 battery line, and they did it while staying in the black. And crucially, they're executing what I'd call a geographic hedging strategy.
Geographic hedging, that sounds sophisticated, but what does it actually look like on the ground?
It looks like survival through diversification. They aren't just fighting for scraps in the domestic Chinese market, which, as we know, is completely overcrowded. They have partnerships in India with Ather Energy, a major player in the two-wheeler market there. They're working with Canny Technologies in the U.S. to get around some tariff restrictions, and they just secured a $7 million order from a European client. So the stock is trading at a price to book of 0.59. You are literally buying a profitable, growing manufacturer for 60 cents on the dollar of its hard assets. That is the definition of deep value.
I see why you think that, and yeah, on paper, the income statement looks better, but let me give you a different perspective. You're focused on the income statement, I'm looking at the balance sheet, and it is flashing bright red. The current ratio is 0.69.
Which is tight, I'll admit.
It's not just tight. Technically, a ratio under 1 means that for every dollar of liability they have due within the next 12 months, they only have 69 cents of liquid assets to pay it. Total cash is just $10.5 million. That is an incredibly short runway for a manufacturing company. You have to buy lithium, you have to buy cobalt, you have to pay wages. If a big payment comes due and that cash isn't there, the value of the factory doesn't matter one bit.
They've managed their working capital effectively so far, though.
So far is the key phrase there. And you cannot ignore the regulatory overhang. NASDAQ listing rule 5550A2. This stock has been under $1 since October of 2025. The deadline is March 30th, 2026. If they don't get that bid price above $1 for 10 consecutive business days, they face delisting or a reverse split. And we all know what reverse splits do to retail momentum. They kill it. And furthermore, let's just be honest about where they stand in the food chain. They are a Tier 4 player with only about 2.3 gigawatt hours of capacity. In 2024, China produced 1,170 gigawatt hours of batteries. CBAT is a drop in an ocean that is currently flooding.
I want to pick up on that small fish idea because I think it leads directly into our first core debate point. Valuation relative to peers. There is this massive Chinese discount being applied here that just defies logic when you actually look at the multiples. CBAT trades at roughly, 0.4 to 0.5 times price to sales on a trailing 12-month basis. Okay, let's compare that to Western peers. Look at Microvast. They trade at 2.19 times sales. And Enovix trades at a massive 45.98 times sales.
But you have to look at what you're buying. You can't just compare multiples in a vacuum. Enovix is selling a story of a silicon anode revolution.
Exactly. They're selling a story. I'm looking at what I am buying today. And today, I'm buying a company that made a profit in Q3 2025. Microvast posted net losses of over $195 million. Enovix is burning cash to scale technology that's still proving itself. EOS Energy is valued entirely on future scaling predictions. CBAT is the outlier here because it's valued on current distress, while all the others are valued on future dreams.
But the market pays for dreams. It pays for growth and for disruption.
It pays for them until interest rates rise or liquidity dries up. Then it pays for earnings. Even a slight mean reversion for CBAT, let's say it moves from half-time sales to just one-time sales, that creates 100% upside. The gap is just too wide to be efficient. You have a profitable company trading at bankruptcy valuations versus money-losing companies trading at tech valuations.
That's a compelling argument for a spreadsheet, but have you considered that maybe the discrepancy exists for a very good reason? Markets aren't usually that inefficient without a cause. Enovix is growing revenue at 85% year over year. They're seen as a tech disruptor. CBAC is a commoditized manufacturer. The market pays a premium for disruption. It does not pay a premium for a Tier 4 manufacturer making standard cylindrical cells in a market that's suffering from massive overcapacity. You mentioned Microvast trading higher, but they target heavy transportation with specialized systems. CBAC is fighting a price war in the most brutal market on Earth.
But are they really fighting the price war in the way you suggest? This brings me to their manufacturing pivot and product strategy. You call them commoditized, but the launch of that Model 4135 battery line in October 2025 tells a very different story. This is not just another battery.
It's a cylindrical lithium-ion cell. It's fairly standard technology, isn't it?
It's the application and the form factor that really matters. The 4135 is a larger format, higher energy density cell that's specifically suited for light electric vehicles. So think e-scooters, e-bikes, and energy storage systems. This is not the same cell going into a Tesla Model Y, where the competition is absolutely cutthroat. They aren't trying to be Cattle or BYD. They're trying to dominate a specific form factor. And they already hold a 19% global market share in the 32-140 niche. They're specialists.
Entering the high-end EV market, but it is entirely speculative at this stage. And the macro reality is what worries me. China's battery production rose 24% year over year. There's a massive glut. Utilization rates across the entire industry, meaning how often the factories are actually running, are dropping because everyone built too many factories. So how does a tiny player with 2.3 gigawatt hours of capacity survive when the big boys are just slashing prices to keep the lights on?
They survive by not playing the same game. That's why the India partnership with Ather Energy is so critical. India is the world's largest two-wheeler market, and they're aggressively electrifying. They want to diversify away from the major Chinese giants for, geopolitical reasons. CBAK fits that middle tier perfectly. They're Chinese, yes, but they aren't some massive state-linked conglomerate that scares foreign regulators. And look at the energy storage system, or ESS market. That grew 64% in China in 2024. That is their focus. They're finding these pockets of demand that completely bypass the general EV glut.
Pockets of demand are great, but are they profitable pockets? Margins in the ESS space are notoriously thin.
The Q3 earnings beat proves they are profitable. If the price war was really killing them, they wouldn't have posted a positive EPS of 3 cents. They would have posted a massive loss like almost everyone else. The fact that they were profitable during the peak of this price war suggests their cost structure is leaner and their niche is more protected than you're giving them credit for. They've streamlined their production to be agile, unlike the giants who have these massive fixed costs to cover.
Look, profitability in one quarter can be engineered. You can delay paying your suppliers, you can move inventory around and make the numbers look good for a snapshot in time. Solvency over a year cannot be faked. And this leads me right to the sentiment indicators. Because if this story was as clean as you're saying, undervalued, profitable, growing, the insiders would be buying hand over fist. They would be soaking up every single share at 80 cents, but they aren't.
The institutions are buying, though. And I would argue that their due diligence is often a lot deeper than an individual insider's market timing.
Let's talk about that, but we have to weigh it against what the insiders are actually doing.
Okay, let's look at the smart money. The 13F filings from November 2025 are incredibly telling. Renaissance Technologies, RenTech, one of the most sophisticated quant funds in the history of finance, opened a brand new position of over 66,000 shares. Susquehanna increased their stake by a massive 1,898%. Citadel increased by 91%.
Those are impressive names, sure.
They're the best in the business. These are not retail traders on Reddit guessing on a meme stock. These are algorithms and quants that detect statistical anomalies. They're seeing that the stock is undervalued relative to its tangible assets and its earnings potential. When RenTech and Citadel are both moving in the same direction on a microcap, you have to pay attention.
I respect RenTech as much as anyone, but I just don't buy that institutional signal is the primary indicator when you look at the insider reality. On December 3, 2025, Li Yunfei, a beneficial owner holding more than 10% of the company, disposed of over 10.4 million shares. 10 million shares.
But we have to clarify that transaction. It was a non-open market transaction. It wasn't a dump on the open market that crashed the price.
It doesn't matter if it was open market or a private placement. A disposition of that size by a key insider signals a complete lack of conviction. I mean, if Li Yunfei believed that 2026 was going to be the year the stock goes to $2 or $3, why get rid of 10 million shares at these depressed levels? It signals a desperate need for liquidity, and that aligns perfectly with the company's tight cash position. You have insiders getting out or at least restructuring to get cash, while you have quants pointing a statistical arbitrage game for a few pennies. I will trust the insider's action about the fundamental health of the business over an algorithm hunting for mean reversion every single time.
I think you're reading way too much into a single transaction that likely has to do with personal liquidity or restructuring, which is common with major holders in China. It could be tax-related, it could be for another venture. The lack of open market selling by the broader insider group is also a signal. If the ship was actually sinking, we'd see a flurry of Form 4s. We just aren't seeing that. But I do want to address the elephant in the room that you brought up earlier, the NASDAQ compliance clock. This is the timeline that really matters.
It is the single biggest risk. It's binary. They have until March 30th, 2026. That is just weeks away now. They need the bid price above $1 for 10 straight business days. Right now, we're at 80 cents. They are 20% off the mark. If they don't hit it naturally, they have to do a reverse split.
I admit the risk, it's real, but I frame it as a special situation investment. Let's just play out the scenario. Let's say they do a reverse split, say 1 for 5.
It's ugly. The algos will short it immediately.
It's ugly for a week, maybe 2. The algorithmic shorters attack it. But does a reverse split change the fact that analysts are projecting 2026 EPS of 8 cents? Does it change the fact that revenue is climbing toward $100 million per quarter? It doesn't change the factory. It doesn't change the contracts with Ather or Condi. If they solve the compliance issue, even through a reverse split, and then they deliver those earnings, the distress discount completely vanishes. The market hates uncertainty. Once that March deadline is passed, one way or another, the uncertainty is gone and the fundamentals take over.
You're assuming they can reach $100 million in revenue per quarter without raising more capital.
And this goes right back to my liquidity point. To ramp up to that kind of volume, you need working capital. You need to buy materials. You need to ship product. You need to pay your labor. They have $10.56 million in cash. They cannot support a $400 million annual run rate on that tiny cash pile. It's mathematically impossible. They will have to raise money.
Which they can do. They're a public company.
But at what cost? If they raise money at these depressed levels or immediately after a reverse split when sentiment is at rock bottom, the dilution to current shareholders will be severe. That is the trap. You might be right about the company growing, the company might survive and even thrive, but the equity holder could get washed out in the process. You could own the stock and still lose money while the company succeeds because your stake gets diluted to practically nothing.
That is a fair concern about dilution, but debt is also an option. Their debt-to-equity ratio is only 0.31. That is remarkably low for an industrial firm. They have room to leverage the balance sheet slightly to bridge that gap, especially now that they're profitable. Lenders are much more willing to talk to a company with positive net income than one that's burning $200 million a year like their competitors.
In this high interest rate environment, for a Chinese microcap, that debt is going to be expensive. We're talking double-digit interest rates.
Expensive, perhaps, but available, and preferable to equity dilution. Look, the beta on the stock is 0.42.
Meaning it doesn't move with the broader market.
Exactly. The stock has been dead money. But that low beta also suggests it's coiled. It hasn't participated in any of the broader market rallies. If they hit that 8-cent EPS target for 2026, you're looking at a stock trading at 10 times forward earnings, growing revenue significantly in a hot sector. Most battery companies trade at 30, 40, or infinite times earnings because they have none. The upside asymmetry is just undeniable. You're risking maybe 20 cents of downside for potentially dollars of upside.
If, that is the key word, if they hit the target, if they don't get delisted, if the liquidity holds, if the insiders stop selling, if the massive 24% production glut in China doesn't force prices down another 10%.
Well, investing is about probability, not certainty. And I believe the probabilities have shifted in their favor post Q3 2025. The market is just slow to update its priors. It still sees a struggling, cash-burning Chinese battery maker. It hasn't woken up to the profitable niche-dominating manufacturer that just emerged.
And I believe the risks have crystallized as we get closer and closer to March 2026. The market sees a company that's running out of cash just as the regulators come knocking.
Let's bring this to a close because I think we've clearly laid out the battlefield here. You see a trap, I see a springboard.
Look, I acknowledge the operational improvements. I can't deny the Q3 beat was impressive. It surprised me. But I just cannot look past the balance sheet. The combination of that March 2026 regulatory deadline, the 0.69 current ratio, and the massive insider disposition just makes the risk-reward profile too dangerous for me. It is a wait and see. I would rather buy it at $1.50 after they've proven they survived the compliance check and the liquidity crunch than at 80 cents hoping they don't drown.
And I see a classic asymmetry. The market is pricing CBAT as if it is going bankrupt, trading below book value with all this negative sentiment, yet the company just turned a profit and upgraded its factory. I believe the institutional buying from Renaissance and Susquehanna is the signal to follow, not the noise of the regulatory deadline. If you wait for $1.50, you miss the first 90% of the move. That's the premium you pay for certainty, but it's too high a price for me.
That is the gamble.
It is. We can definitely agree that 2026 is the binary make or break year. The Q3 earnings beat was either a complete fluke or the start of a massive re-rating.
The next few weeks leading up to March 30th are going to tell us everything we need to know.
Indeed. Thanks for listening to The Debate.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.